Are you trying to get a new loan and you're trying to figure out what all the terminology means and have a basic understanding of what kind of loans are out there? If so, this is a video for you. This is Ron with Keller Williams Elite with the Ron and Jill Group. Before we get started, hit that subscribe button down below. Turn on the bell for notifications. We are posting a lot of content here weekly, so let's get to the show. Something to keep in consideration when you're out there looking for a loan and what the right type of loan for you is have an understanding that not all lenders are created equal. And when it comes to that, you have to understand the listing agents, they are going to do their own due diligence and they're going to look into how good the loan is for a prospective buyer. After all, they are protecting the seller's interests. One of the things to do is stay away from some of these online ads you're seeing for an easy, quick pre-approval. That leads into problems later on down the road. Because at the end of the day, the listing agent is going to call up the lender and start asking a bunch of questions. I have done this with all of my clients that I represented for selling their homes. I'll ask questions such as, hey, what is the debt to income ratio? Are they going to be able to afford the payment? Is there anything that they're trying to take care of between now and closing that could impact them purchasing the home? Now here's where it gets good. On the pre-approval letter that you get, regardless what lender you go to, it's going to show what kind of loan it is. Let's start with, what is a conventional loan? This is a loan not insured by the federal government. There are two types of conventional loans. The first one is conforming. It falls into the standards of the FHA guidelines, which stands for the Federal Housing Administration. And the second one, non-conforming. It does not fall into the FHA guidelines, and the buyer is going to have to pay PMI insurance. They're putting less than 20% down. Here are some things to understand when it comes to the conventional loans. With the conventional loans, they can be used to purchase your primary residence or a secondary residence. These conventional loans will have a set max limit to what the amount of the loan will be. And this will be dependent on where in the country you live at. It is $647,200 in Maricopa County. That is what the max limit is for a conventional loan. And usually the max limits are increased year over year over year. And with a conventional loan, there's usually lower cost to get the loan. A good thing with a conventional loan, you can ask the lender to cut off the PMI when the home has at least 20% of equity. Good thing about this is it's only 3% down. One of the things you have to have with a conventional loan is a FICO score of at least 620. Your debt to income ratio has to be between 45 to 50%, no more than 50%. You'll more than likely have to pay PMI if you put less than 20% down. That's pretty much common for everybody. So there is a lot of paperwork that you'll have to provide to the lender. A big one is verifying your income. What assets do you have put away, whether it's in savings, stocks, or whatever? Where did you get the down payment? How long has it been in your accounts? They're also going to want to verify your employment. And usually when it comes to fixed rates and conventional loans, they pretty much go hand in hand together. And something to understand when it comes to fixed rates is it is the same interest rate throughout the whole entirety of the loan. And this is really good, especially when the interest rates are going to increase and you're locked into a lower interest rate. That is pretty good. Next one is the jumbo loan. And when it comes to the jumbo loan, I've seen people confuse jumbo loan with balloon payments. They're totally different things. When it comes to the jumbo loans, it is you're going over the maximum allowed for the conventional. So if you're trying to get a home in a higher end area and it's over $647,000, once it goes over that, you are now in a jumbo loan. And like I said, this usually comes into the higher end areas or where the homes are starting to get extremely pricey. You get more documentation to support the fact that you can make these higher payments and take out more money for a home loan. And when it comes to the jumbo loans, they're pretty competitive when it comes to the rates for other conventional type of loans. However, when it comes to the jumbo loans, they may require 10 to 20% down. Also, when it comes to the FICO, you have to have at least a 700. There are some jumbo loan programs out there that may require a 660. Your debt to income ratio has to be below 45%. Also, you must have at least 10% in assets in your savings account. So that is 10% of the purchase price of the home. So that is conventional. They are pretty common out here. I haven't seen too many jumbo loans unless you're going to like some really expensive areas. But for the most part, it is the conventional non-conforming. The next one on the list is there are 3 types of federal backed loans. This does not mean that the federal government is issuing out loans. This pretty much means that federal government is going to insure these loans up to a certain percent. The first one, and this is a really common one out here in Arizona and pretty much anywhere else in the United States, and that is an FHA loan. And like I said, these are pretty much the most common type of loans you're going to see. With an FHA loan, it's going to require about a 3.5% down. When it comes to the FHA loans, they are pretty forgiving and pretty relaxed when it comes to the credit score. When it comes to the FHA loans, you have to have at least a 580. There are some FHA loan programs out there that only require a 500. However, you have to put down at least 10%. When it comes to the FHA, you may have to put down the PMI as part of the closing costs. The next one is the VA, which is the Veterans Administration. This is given to people that are on active duty or they're military veterans. Now, the good thing with the VA is that it is a 0% down. However, when I do work with the veterans, I will tell them straight up, you will have to provide some closing costs. Even though you have 0 down and everybody hypes the 0 down, it doesn't mean that there is 0 closing costs. Also, a good thing when it comes to the 0 down and you will have to pay the closing costs, get with the lender. They can help you out if the closing costs are an issue. Another good thing when it comes to the VA is there is no PMI. Next is the USDA, which is the United States Department of Agriculture. And this is for moderate to low income families. And with these programs too, you may not require money down. And some things to know when it comes to these government-backed loans, and this will help out homeowners that cannot qualify for a conventional loan. The credit requirements are a lot more lax than what people may think. You may not have to put down the huge amount like a 10-20% down, and with some of them is 3% down or nothing down when it comes to getting into a home. And these programs are open to first-time home buyers or people using them over and over and over again. Now, there will be the mandatory PMI, and something to do when it comes to the PMI is to go ahead and refinance or renegotiate with the lender to see what they could do so the PMI can be knocked off of your house payments. However, when it does come to these government-backed loans, there may be higher costs associated with using some of these programs, and you will have to provide a lot of documentation to back up to see if you qualify for certain types of loans. Also, something that is going to be coming up, and I'm sure you've already seen it, whether you have a fixed rate over here or an adjustable rate. Both of them have their good points about them, and both of them have good points, and there are some bad points for either one. With the fixed rate, it's usually a little bit lower the first few years. With the adjustable rate, is usually a little bit lower the first few years. However, it's going to be moving around and adjusting year over year depending on what the market is. And when this adjustable rate does happen and the interest rate does go up, I have seen some homeowners get themselves into hot water where they can no longer afford their house payments. And this can lead to foreclosure, and it's a whole big mess. On the opposite side, if the home values do drop in price, this may make it harder for them to refinance or to sell their houses. In this current market we're in right now, that's not so much the case because by and large, interest rates are pretty low. However, things come and go, and the housing market comes and goes in cycles. Alrighty, everybody. Hope you found value with this. Please, before we leave, hit that subscribe button down below. Turn on the bell for notifications. If you want to talk to me, I have a link in the description below to set up my Calendly, and let's go ahead and schedule a time to talk. Until then, we'll see you soon.